Hello everyone, today we're going to talk about fundamental analysis and what is it. Fundamental analysis is method of measuring securities intrinsic value by examining related economic and financial factors. Fundamental analysis study anything that can affect the securities value, from macroeconomic factors such as the state of the economy and industry conditions to microeconomic factors like the effectiveness of the company's management. The end goal is to arrive at a number that an investor can compare with the security's current price in order to see whether the securities is undervalued or overvalued. This method of stock analysis is considered to be in contrast to technical analysis, which forecasts the directions of prices through the analysis of historical market data such as price and volume. Fundamental analysis is a method of determining a stock's real or fair market value. Fundamental analysis search for stocks that are currently trading at prices that are higher or lower than their real value. If the fair market value is higher than the market price, the stock is deemed to be undervalued and a buy recommendation is given. In contrast, technical analysis endures the fundamentals in favor of studying the historical price trends of the stocks. Understanding fundamental analysis. All stocks analysis tries to determine whether a security is correctly valued within the broader market. Fundamental analysis is usually done from a macro to micro perspective in order to identify securities that are not correctly priced by the market. Analysts typically study in order the overall state of the economy and then the strengths of the specific industry before concentrating on individual company for performance to arrive at the fair market value of the stocks. Fundamental analysis uses public data to evaluate the value of a stocks or any other type of security. For example, investors can perform fundamental analysis on a bond's value by looking at economic factors such as interest rates and the overall state of the economy. Then studying information about the bond is used such as potential change in the credit rating. For stocks, fundamental analysis uses revenues, earnings, future growth, return on equity, profit margins, and other data to determine a company's underlying value and potential for future growth. All of this data is available in the company financial statements. Important. Fundamental analysis is used most often for stocks, but it's useful for evaluating any security from a bond to a derivative. If you consider the fundamentals from the broader economy to the company details, you are doing fundamental analysis. Investing and fundamental analysis. An analyst works to create a model for determining the estimated value of a company's share price based on public available data. This value is only an estimate. Analyze educated opinion of what the economic share price should be worth compared to the current market price. Some analysts may refer to their estimated price as economics intrinsic value. If an analyst calculates that the stock's value should be significantly higher than the stock's current market price, they may publish a buy or overweight rating for the stock. This acts as a recommendation to investors who follow that analysis. If the analyst calculates a lower intrinsic value than the current market price, the stock is considered overvalued and sell or underweight. The recommendation is issued. Investors who follow this recommendation will expect that they can buy stocks with favorable recommendations because such a stock should have a higher probability of rising over time. Likewise, stocks with unfavorable rating are expected to have a higher probability of falling in price. Such stocks are candidates for being removed from existing portfolios or added as short positions. This method of stocks analysis is considered to be the opposite of technical analysis, which forecasts the directions of price through an analysis and historical market data such as price and volume. Those interested in learning more about fundamental analysis and other financial topics may want to consider enrolling in one of the best investment courses currently available. Next is the problem with defining the word fundamentals is that it can cover anything related to the economic well-being of a company. They obviously include numbers like revenue and profit, but they can also include anything from a company's market share to the quality of its management. The various fundamental factors can be grouped into two categories, quantitative and qualitative. The financial meaning of these terms isn't much different from their standard definitions. Here is how a dictionary defines the terms. Quantitative related to information that can be shown in numbers and amounts. Qualified relating to the nature or standard of something rather than to its quantity. In this context, quantitative fundamentals are hard numbers. They are the measurable characteristics of a business. That's why the biggest source of quantitative data is financial streams. The revenue, profit, assets, and more can be measured with great precision. The qualitative fundamentals are less tangible. They might include the quality of a company expertise, its brand name, recording, patents, and proprietary technology. Neither qualitative nor quantitative analysis is inherently better. Many analysts consider them together. Qualitative fundamentals to consider. There are four key fundamentals that analysts always consider when re-judging company. All are qualitative rather than quantitative. They include the business model. What exactly does the company do? This isn't as straightforward as it seems. If a company's business model is based on selling fast food chicken, is it making its money that way, or is it just costing on royalty and franchise fees? Competitive advantage. A company's long-term success is driven largely by its ability to mount into competitive advantage and keep it. Powerful competitive advantage such as Coca-Cola's brand name and Microsoft dominations of the personal computer operating system create a moat around a business, allowing it to keep competitors to buy and enjoy growth and profits. When a company can achieve a competitive advantage, its shareholders can be well rewarded for decides management. Some believe that management is the most important criterion for investing in a company. It makes sense. Even the best business model is doomed if the leaders of companies fail to properly execute the plan. While it's hard for retail investors to meet and thoroughly evaluate managers, you can look at the corporate websites and check the resumes of the top brass and the board members. How well did they perform in prior jobs? Have they been unloading a lot of stocks shares lately. That's all. Thank you for your attention and goodbye.